Okay, thank you guys so much for joining today, and let's get right into it. Our topic for today is unlocking hidden market gems. Is unlocking hidden market gems, a live guide to proper trading analysis and psychology. We know the foreign exchange market is vast, is broad. Not only is it just that, but we also believe that it is technical. As much as it is technical, there's a need for us to properly understand how to carry out analysis without forgetting that psychology is the real game when it comes to the financial market. So be it the foreign exchange market, your trading CFDs, stocks, or just investment in general. There's a need for you to always understand the proper and right analysis to carry out before making any financial decision. Okay. And for today, I would be your host and your educator. And my name is Innocent Ifere, popularly known as Rion. I am the educator for Africa at Valetax. And as you can see on my screen, I help traders escape confusion with clarity. And as God will have it, it's been close on 5 years of experience in the financial market as an analyst, as a trader, and as an educator as well. And my aim and goal today is to help you see a different light in the market and instill in us the proper information and knowledge that is required for us to go out into the chaos of the markets, the charts, and the battles we all go through as traders to actually come out on top. So today we're going to be looking at a couple of things that I have highlighted for us. Okay. And they are why most traders fail. We need to understand why most traders fail. And what you'll learn tonight is not just about why traders fail, but also how to go about understanding certain things that I personally believe that are germs in the market, that if you can understand this concept, they would help you refine your edge and also make you find a better approach or system towards proper technical analysis and also your psychology as a trader. And why exactly is this session different? This session is different not just because you've not attended any webinars relating to the foreign exchange market, or you've not attended other seminars or classes or any of these things. But as you can see on the screen, there's a name on each screen that you're seeing right now. And you've also been invited to this webinar by a company known as Valetax, a broker that is not just interested in you being just any trader, but wants the best for you. A broker that positions itself to put education first before every other thing. A broker that has positioned itself over time to pay focus and prioritize knowledge and trader sustainability in the market over a long period of time is Valetax. And that is why this session is different. I don't know if any of you on the call have had experiences to attend webinars done by brokers to teach you, but this is extremely new to a lot of you. And I'm glad that you've keyed in to actually come to this webinar today and enjoy it. And not only is the broker wanting to educate you, but is even allowing that we give you insights on how to trade the market better. So this is also supposed to reshape your mind, your mindset, and your ideology towards, brokerage, especially Valetax, to help you know that Valetax is not just after you as a trader, but it's after you becoming the trader that you are supposed to be and actually becoming successful when it comes to trading. Okay. So we're going to, start out, very easy and not try to, overload you with too much information, but try to keep the information as simple as possible. So first things first is, why do traders fail? So let's go back to the first thing on this this PowerPoint page right now. Why do traders fail? Why do most traders fail? You see, why most traders fail isn't just because of they don't understand technical analysis or they are not interested in learning technical analysis the right way or wanting to get it better. But the problem is a lot of them do not have the patience to keep going. A lot of them could not survive the emotional and psychological warfare that comes with being a trader. So being a trader isn't just because you know how to use support and resistance, or you trade institutional concepts, or you trade basic retail concepts. That's not the necessary thing that makes you a trader. Yes, technical analysis is important, but it's not entirely what is needed to make you become a profitable trader over a long period of time. Now, traders can be profitable, but at the end of the day, it's the sustainability of that profitability that is most important. And everybody is going to have their ups and downs. So that is why I tend to advise people to look at trading as a business. So don't just see it as a get rich quick scheme or some sort of game or an online digital, opus operandi that you just come in and you do one or two things and you make money and you go. That's not how the market really works. If that's how you want to view the market, then you're going to be in a constant rat race where you keep going in circles, make profit today and then you lose for like 2 years and then you come back. And that's the cycle that a lot of people have been stuck in. There are people who have been trading for 20 years and still can't brag about being profitable. They've only seen profit once or twice in that period of time that were, probably sufficient. But now there's an emotional warfare and a psychological warfare that every trader goes through. The battle between yourself, your mind, and your financial capacity. Now, how do you navigate through this thing? It's first by understanding the need for you to understand yourself, understand that the game is not going to be easy, but you have to persevere. The people who win are the people who don't give up. The people who win are the people who take the risk on themselves. Now, mind you, I didn't say to risk your account, but to take the risk on yourself. So these are some of the reasons why traders fail. And this webinar is going to help you navigate your way around that and see how you can improve and how you could change certain things about yourself. Okay. So let's look at where most traders get it wrong. Okay. A lot of times a lot of traders talk about, support resistance and smart money entries or systems. And then they just want to use everything at the same time without fully grasping the knowledge about it. Now, as much as the retail part of, trading talks about support and resistance, it does not necessarily mean that you should make random entries. So this is why random entries can hurt you as a trader. If one single knowledge is not enough for you to make headway, there's a need for you to build confluences around the market. So without confluences, then you're going to be making random entries. So you need to understand your why, you need to understand your what, you need to understand your where, and you need to understand your how. So this is what I mean. What are you trading? Why are you trading it? Where are you expecting prices to get to? Okay. And how do you expect prices to get to that point? Or how do you want to make an entry on that point? Or how do you want to take this trade? How do you plan it? So your how basically is your trade plan. So your trade plan is supposed to carry everything. Your what? So if you're going to be trading, let's say US 30, for instance, why are you going to be trading US 30? Where do you expect prices to be going to when you're trading US 30? How do you expect to take the trade? Like, do you have a system? Are you going to be using a naked chart system where you're trading basic levels, break and retest, support and resistance, which is, usually called the retail system? Or are you going to be applying a smart money concept, okay, a smart money retail concept to it? Will you be using things like liquidity sweep, order blocks, confluences? Have you built a system around this have you built a strategy rather around these systems, and how do you intend to use them? So these are some of the things where a lot of traders get them wrong. So some people just go probably read the candlestick trading Bible. They see, okay, when prices break and retest, they enter the trade, or they use they read baby pips and then they learn break and retest, and that's just it. So these things leave discrepancies in knowledge, because at the end of the day, you don't use one thing to make sense of the market. There is a need for you to actively refine your edge and understand how it works. So you need to be paying attention to confluences like, okay, even though I understand support and resistance, there's going to be a need for me, first of all, to not just use support and resistance in the market. Even within the books that you read, they tell you that this alone does not give confluence to why you should take a trade. You need to pair them with other things. So this is where your understanding of, trying to implement fundamentals in your trading, trying to use, certain indicators that are very simple, not bombarding your charts with a lot of indicators, but learning one or two indicators that helps bring light and confluence into your trading. Now, these things give you the confidence to actually take a trade. So where most people get it wrong is they just want to do it anyhow. Now, nonetheless, I'm not trying to say don't keep it simple, because at the end of the day, simplicity is best. But within your simplicity, you want to pay attention to having not just one, but two, three, four things give you a reason as to why you should take a trade. And that is where most people get it wrong. Okay. So the next thing we're going to be looking at is what really is proper technical analysis approach. Okay. Now, like you can see on my PowerPoint, always feel free to, take screenshots. And even if at all you don't take screenshots, I believe that this webinar will be, we will put up on the Valetax YouTube page for you to have access to it again. So now, what do most traders focus on? A lot of traders, even some of us on this call, are guilty of it. We focus a lot on signals, patterns, and indicators, or we just focus on candlesticks alone. But like you see what was on my chart here, proper analysis, okay, proper technical analysis about understanding why, what, and where of price movement, and how. My error in the WHO is supposed to be HOW, is supposed to be how. Okay. So now you need to understand the actual flow of market, movement, structure, cycles, and everything. And you also need to come to an understanding with yourself that helps you know that the market is randomized. The market is randomized. So there is a need for you to actually understand and create things that would give you balance and help you clean the chaos in the market, because the market is very chaotic. Everybody can do anything they want. So what I usually tell myself is the market is forever going to be an anarchy. It's those who create the rules for themselves that stay longer in the game. And I learned that from a popular trading psychologist, the author of Trading in the Zone, Mike Douglas. Okay, so these are things that you want to pay attention to. Now, what are the three core pillars for me? Okay, first is structure over signals. A lot of times people call signals, you could be in different Telegram groups and you see different signals. Sometimes some people are buying the same assets on which you're trying to sell. Some people are selling while you're buying. It's because at the end of the day, people would always see different things in the market depending on the lens in which they used to view the market. So some people could be long-term, some people could be short-term, some people could be scalpers, but it's not just about signals, but it's about paying attention to structure. So structure is your number one go-to when it comes to understanding the market. Structure is very important. Now, the next thing that you want to pay attention to is liquidity. See, liquidity is king. The whole market is liquidity. From the people buying to the people selling, it's all liquidity. The very moment you place a pending order, that's liquidity. The very moment you put a stop loss, that's liquidity. Why is this liquidity? Is because at the end of the day, we are in the market to what? We're in the market to take advantage of price movements. And what are these price movements? It's all about money. So liquidity basically means money. So every time you place a trade in the market, you've put money on the table. Every time someone else places a trade, they're also putting money on the table. So if you're betting against the person on the order position, it means you're either buying their order or they're buying your own order. So at the end of the day, it is one person has to come out on top. So it's always about liquidity. So once you can understand where the liquidity is in the market, then you also have created an edge. Now, confluence. And I would always sing this thing. Confluence is your filter, is how you clean the noise from the market. And why is that? That's because everybody could be seeing the same thing, but an edge for you as a trader is you creating something that you see and gives you an advantageous effect in the market. So everybody could be, let's take for instance, okay? A lot of people were trying to buy gold since yesterday and till today. And I personally, for once, kept saying, there are no bulls in the market for gold. There are no bulls in the market for gold. Why? I have an advantageous effect of how I view the market. And it comes from understanding structure, chart patterns, and what? And momentum. So that gives me confluence. So you need to find things that would help you filter the noise in the market. So where everybody is seeing something different, you can see something for yourself and you know that, okay, this works. And you just don't create confluence like that. You have to create a confluence that has proven itself, has gone through the test of time. You've tried it, you've back tested it, you forward tested it. You know that this works. You've seen it 1, 2, 3, 4, 5, 6, 10 multiple times. Because at the end of the day, confluence isn't just built in a day, it's built as a result of price and pattern recognition in the market. So you must have seen that thing happen severally, and that gives your confluence a better edge. Okay, and I hope you guys are following. So if you're following, just leave something in the comments, in the chat section for me. Just leave an emoji, drop a fire emoji if you're listening and if you're understanding. Drop a fire emoji for me. Let me be sure that we're all following. Drop a fire emoji, type Valetax if you're all following. Leave it in the chat section. Leave it in the chat section. Just leave it in the chat. Just type Valetax with fire emoji. Let me be sure that you are following. And if you also have questions so far, just leave your questions so as well, guys. Come on, guys. Let's do that. Let me see something in the chat section. Okay. So next for us now is fundamentals. Okay. A lot of times I always say this thing that fundamentals. So this is like number 0 gem when it comes to me. This is like a key important thing when it comes to trading. So this is my number 1 tip and gem for us. Very valuable gem. Understand the market. See, the foreign exchange market isn't just technical analysis. Candlesticks don't just appear from anywhere. They don't just happen because me and you understand, exist. At the end of the day, we as retail traders trading CFDs, we are trading off the back end of a large transaction between banks, hedge funds, reserves, multinational and transnational companies. These are the real liquidity makers in the market. What we are doing is retail. So just use a normal market scenario. Look at them as wholesalers, and then we are retailers, and then in fact, we're not even retailers, we are the last consumers, basically. So you need to understand that these things happen as a result of transactions. Not only do they happen as a result of transactions, but they also occur due to economic situations and circumstances around the countries that you're trading their currency pair. So the market is first economy before it becomes transactions, before we then start to see the ripple effect of strength and weaknesses around the currencies. But if you can fully grasp and understand how an economy operates, what could be moving the economy, then you have a better edge over the market. So now you're not just trading from a place of, oh, I see break and retest, or I see support and resistance, or I see trend line. You are now trading from a place, okay, that helps you understand that, okay, the reason why I might be going short or going long on this certain asset or on this certain currency pair is due to what? Due to the economic and financial standing of this currency's country at this very point in time, or because a certain company or a certain bank has listed or has outlined series of transactions that they want to do. So all of these things, part and parcels, relate back to why a trade should work or a trade should not work. It it reveals the reason why prices move the direction they go to or why they don't move at all. So you need to understand them. So what are the fundamentals that we're talking about? We're talking about things like, news, geographical news. So it could be things like, geopolitics, it could be wars, it could be big company transactions, especially when you're trading things like indices, US 30, the Nasdaq, German 40, the Nikkei 25, all of these kind of indices. You also want to look at like major transactions of these companies. What are their quarterly reports like? What are their monthly reports like? Are they doing well? And all of these things. So you need to have an in-depth understanding a bit, not just technical analysis every time. So for currency pairs, we're looking at things like interest rates, we're talking inflation, we're talking sentiment overall, market sentiment overall. So recently we see inflation numbers, hanging between 2.3 to 2.8 on the USD. We see Trump calling for Powell to cut rates because he's trying to do what? He's trying to drive in more borrowing, and he wants companies to be able to borrow more money and get more loan to build companies to facilitate his industrialization growth plan in the US. And so he's calling for interest rate. And we also see Powell saying, oh, the economy is good, but it's not so, good enough due to the whole tariff, problems and everything that Trump is doing. He wants to see better stability in the economy before cutting rates. And we saw today as FOMC, he still didn't cut rates. He left rates normal at 4.25 to 4.5, as he has left it since the start of the year. So things like this gives you headway to understanding the market better. Okay. Now, you also need to understand that market structure adapts to sentiment. Structure doesn't just happen through isolation. So if today we had seen an interest rate cut, the dollar would have gotten weaker. They would have seen a very short on the USDX. That's the DXY. Why? Because a lot of people would have gone short on it due to the interest rate cuts to enable people to actually do what? To finally start getting money at a cheaper rate. And since the economy would get dovish, it will then bring in better what? Better use of money. So people would start to, invest at a cheaper rate. That was what we would have seen. And that would have immediately shifted the structure of the market from the present bearishness we see from anything based the dollar into a bullish move into the market. So you see, structure don't just happen, they happen due to sentiment and what? Fundamentals in the market. Okay. So you don't want to use fundamentals alone. You also want to pair them with technical analysis. So let's take, for instance, there's a high impact news that's supposed to come out, probably CPI, and you notice that prices are at a key level, maybe like a weekly support or a weekly resistance. Now you want to understand what's the price action at this point, at this very point. Then you want to wait for the release of the market. If the release of the market is in your favor, then that gives you more confluence to why you should take the trade. So now you see that you've now built understanding and confluence into your trade. Okay. So that is how you use fundamentals. Okay. So next we have liquidity zones. Remember, I said the market is what? Is liquidity, it is structure, okay, and fundamentals, and also building confluences about it. Yeah. So liquidity. Now remember, I did mention about liquidity, and I said liquidity is where money is present in the market. So I don't want to spend so much time on this. I want to break it down to the most simplest form as possible that I can for you. So take this. This market was bullish. Okay. So it means that at this very point in time here, there were people that, had buy positions in the market at this point in time, meaning that they all had their stop losses where you've been taught to place your stop loss just under the previous low where you've taken a position from. So stop losses are under this area here, right? Now, prices sold off again. And then a lot of people would have taken buys. Why would they have taken buys? Because prices did come back. We're into an order block at this point after a break of structure here. So people would have what? Taken buys. Moreover, I know it would be hard for us to understand what an order block is, but I would be explaining it on where? I'll be explaining it on the next slide, okay? So prices have retraced. So let me use a simple word, which is a retracement. So we've gotten a retracement here, and prices is what? Pushing to the upside. So now it means that after this engulfing candle that happened here at where? At a support area, prices, people would have done what? People would have entered for more buy positions. Where would they have placed their stop loss? Under this level here, or people who want to take more swing positions would have placed their stop loss at this level here. Now, buyers came into the market and they went this high and then sold off again. So for people who were trying to swing this trade and got stopped out at this level here, what would they have done again? After prices came to this level of support again, and then we had an engulfing, what's the next thing that would happen? They would have taken more buy positions. After taking more buy positions, where do they have their stop losses? They have their stop losses just below this level again. So meaning that they have taken buys to the upside again. Remember, they are still trying to hold more positions to the upside. Okay. Now, what do we see? Prices sell off again, failing to break this high, signaling that the buy positions are not enough to fuel prices to this level here. So prices sold off again. And where the prices come back to this same level of support, meaning that people who saw this rejection here and an engulfing at this point in time again would do what? Would have entered buys. Now, why does this place become a liquidity zone? It becomes a liquidity zone due to the variable number of times that prices have come back to this level and we've seen buyers come into the market several times. So meaning that everybody at this support level is constantly looking to place a buy position. Not only are they constantly looking to place a buy position, but they've all placed a buy position and have their stop losses at the most best position would be at this level here. So even if prices did not take out the smart ones that had their stop losses here, they are still in this trade, meaning that their stop losses are all still below this zone here. So this is why this place becomes a liquidity zone. So basically what's going to happen is when big money comes into the market, they would facilitate further moves by first taking out the liquidity. Why? Because liquidity is engineered to move prices. So once this liquidity is taken out, the next thing that happens is what? Prices then move to the upside. So that is why once you understand the purpose of engineering liquidity in the market, that gives you a confluence. So when you see a position like this, as much as you want to take, you've taken buys, when you see prices start coming to a level so many times like this, it starts to ring to you that there's a possible accumulation of liquidity at this point. So you want to be very careful. Nonetheless, not saying that you shouldn't take the trade, but it means that when you're taking the trade, you want to be more strategic in placing a trade during this kind of position or in this sort of areas. Okay. So that is for liquidity zones. If you're following, just say, I am following Valetax in the chat section. Just say I'm following Valetax in the chat section. And if you're here and you haven't registered or you haven't created an account with Valetax, please don't forget it is valetax.com. All you have to do is go there and get your account registered, sign up with Valetax and start trading. We have the best spreads on an ECN account with the very minimum deposit, just $50 deposit for raw spread, zero spread accounts. I think is the best you're going to see on any broker so far. Most brokers charge you as high as 1,500 just to get ECN and raw spread. You can get that with Valetax, just $50. Not only do we have that, but we have a competitive affiliate plan. And we also have bonus accounts, and there's an ongoing trading competition that's going to be ending on the 14th of August. And don't forget, you can get into that competition right now and still win the competition for as long as you are certain that you know that you have the capability and you have all the credible skills to actually, beat people who are on top of the table. The table is always fluctuating. First position can become fifth position in a couple of hours. So you still have the chance to get involved in that competition. Okay, so before we move further, let's look at other blocks. Now, remember I said I have a few gems for us, and this is my gem number 2, order blocks. Why are order blocks important? So let me quickly give us an understanding of what an order block is. Okay, so an order block is basically the opposite candle that is formed before a break of structure. So I am going to annotate on my screen now, just so that I can help you guys understand this better. Okay, so this, sorry, let me let me undo this. Let me use a pen. Okay. So uh, okay, so we have structure. Okay. So basically every time prices breaks a new high, okay, every time prices breaks a new high, okay, we refer to it as a break of structure. So usually there is these are all buy moves. Okay, so within these buy moves, we expect to have bearish and bullish candles. Okay, so that last bearish candle before the big bullish candle that actually comes and breaks this structure is what we refer to as an order block. Now, an order block is specific due to smart money concept. Basically, it's an idea that these banks leave orders at this level to come back to mitigate them to finally fulfill their whole transaction. So probably they needed to do a transaction of like 100 million, but couldn't complete the transaction of 100 million due to the present liquidity at that area. So probably what they have is like 50 million. So they leave a remaining order of another 50 million, push prices into the market, and then come back to activate the remaining 50 million and move in the right direction. So that's basically the use of an order block in simple terms, not to confuse you. Now, how do you use order blocks? So using order blocks, you then combine order blocks with liquidity, because why? They also need liquidity to come back to activate that order block. So order blocks are points in the market that you can use as entry triggers to come into the market or enter a trade. Now, do we just use order blocks? No, we don't just use order blocks. And that's where we're going to be leading into the next, the next gem. So now you can clearly see on my you can clearly see on my PowerPoint here that I have a break of structure here, which is a BOS. Then I have the order block here. Now, what you notice is the liquidity that was resting before the order block. Okay, so you see that I mapped out the liquidity zone. And why is it liquidity zone? A lot of people kept on buying and buying and buying, even though prices kept coming back. So every time prices kept coming back, they entered more positions, they entered more positions, they entered more positions, they entered more positions. So all of them have stop losses under this region. And that is why it becomes a liquidity zone. So what did prices do? Prices used this liquidity to fuel the movement back here. Okay. Sweep all the stop losses, take out all the liquidity, tap into the order block, and then prices move into the upside. So that is the importance of an order block. So mind you, this is a bullish order block. If we switch the case, it would be a bearish order block. And similarly, that is how you view it. So we don't just want to use an order block. We want to validate an order block with what? Present liquidity. So you want to make sure that there's liquidity present before the order block, and then you take it. Now we are moving to the next thing that is very important for me. Okay, and that is okay, give me a minute. Okay, confluences. I've been saying confluences from the very start of this call. Confluences is what makes you stand out, is what gives you an edge. So now, personally for me, one of the things I use for confluences and has been advised and verdict and also tested and agreed upon, not just by me, but even by professional institutional traders as well, and traders from way back for like very long time. Okay. For us is confluence is important. Why? Without confluence, you don't really know if you should take the trade or not take the trade. Some people say, oh, it slows you down. But guess what? It's better, it's better slow and good than fast and useless. Taking it slow doesn't mean you're not doing a good job. Sometimes it saves you the risks of people who are trying to do it fast. So let's take, for instance, what I personally use, okay, for confluences is the RSI and the moving average. Now, you see, we have the order block, we have the candlestick, we have prices stopping, we have the liquidity, but it's not just enough for me, because we might think we are right, but you can't be right in the market. See, the market has a high possibility of return, a high possibility of trades working out, but there's also a probability to it. So the probability is what creates the randomness in the market. So you can't for a certain say, I know where the market is going to. You can only speculate, but you can't be certain. So it's through that speculation that you want to do what? You want to create an advantageous position for yourself and for your trades. So how do you do that? By using things that have been created in the market over years by experts. These are all algorithms and mathematical calculations that help, define and understand the market over time. So when you use these things, they help you understand that, okay, you're not just the only person seeing it, but even more professionals can actually see these things. So I use the RSI, which is the relative strength index. Now, why do I use the RSI? The RSI shows me the strength of momentum at that point in time. Either we are at an overbought position, at an oversold position, or we still have momentum moving into an overbought or an oversold position. So 30, 70, 20, 80, those are 80, 80, 80, 70 overbought, 20, 30 oversold. In an oversold position, I want to see the RSI in an oversold position aligning with a key level. So either a key level or what, or an order block or a fair value gap. So once I see prices around that level and I see my RSI at an oversold level, let's assume I'm in a bullish market. So first of all, remember structure is important. So I'm in a bullish structure. I am seeing price, doing a correction before a continuation at this point in time. So now I have my RSI in check, oversold position. Okay. Now prices have reached into my order block. And now that's good. Now what do I look for? Now I look for a candlestick price action. Okay. I see what a candlestick price action. Now, what do I see in the candlestick price action? I see that not only, sorry about that, guys. Okay. I see that not only is candlestick price action showing me something, but I'm starting to see the bulls come into the market with the candlesticks. Okay. So let me see if I can zoom in for us. Okay. Uh, let's go back. Okay. So I can start to see that there has been what? There has been series of range at this point in time. The bulls are coming back into the market, even pushing higher to kind of take out the previous bearish character a bit, and then coming back. And then the next thing I see is what? I don't identify that there's been a huge engulfing bar that's engulfed 1, 2, 3, 4 candles. And then what happened? My moving average. So this is an exponential moving average. Okay. I'll tell us for the sake of it, of 21 period. So 21 or 24 period moving average would work perfectly fine, especially when you are trading on a 4-hourly time frame or a 1 hour time frame. Okay. And then now I see that prices have what crossed above the moving average and is resting on the moving average. Now, this gives me confluence. Why? My RSI is showing me that market is choosing to no longer be bearish. I can start to see buyers coming to the market at this point here. Market buyers are coming to the market at this point here. We've broken above the 50, meaning that momentum is now where heading to the upside. I see my candlestick. I have my order block in check, which is a valid place for what buyers to come back into the market after taking liquidity and is still in line with the market structure. Now, this is confluence. So when you take a trade like this, after identifying confluences in your system that works for you, it helps you go back and fold your hand and just be at peace. So now, basically, what this confluence helps you do is it helps you create a filter from the chaos and anarchy in the market, and also help brings confidence within yourself to fight that warfare, that psychological and emotional warfare. You see, where that warfare comes in most times is where you do not have system and structure in place to help you understand what you're doing. But once you can have that and you're disciplined enough to follow that same rule back to back to back to back to back, you can then start to manage your emotions properly. The only thing you might probably start to battle is the greed, should I close my profit? Should I hold my profits? And all of those fears. But I promise you, once you have a good system in check, that can help you balance and also filter the noise and help you manage that emotional and psychological warfare. The only thing you then have to battle, like I said at that point in time, is the greed, when to take enough money, when to leave a trade, when to stay in a trade, when to close the trade when you're in loss. But if you have a good system that tells you when to take profit and when to take losses, when to cut your losses short, then you're good to go. And that is why conferences are important. If you're still following, please make sure you do leave something. Okay. So I'm just going to go quickly. I'm quickly going to go through the chat section here. Someone saying, please, where else can I learn more about fundamentals to know which currency is bullish or which currency is bearish aside FX book and FX factory? Honestly, you're going to have to study the news itself. Okay. So pay attention to economic news and reports. It could be from any of your news stations. Okay. I can't specifically call anyone on the call for you, but pay attention to news reports. Okay. If you're trading your local currency, pay attention to news reports in your local area, or you pay attention to international news reports as well. If you've been here so far, thank you guys for staying and thank you for being in attendance. If you have any questions, leave your questions in the chat section so I can pay attention to them by the end of the class as well during our Q&A session. Okay. Why the setups fail. Okay. Like I said, it's really not about the charts. Trading is also about you as the trader. Okay. It's about you as the trader and the mind of the trader. So to be a trader, like I said, there's usually something I popularly say to people around and to our students at Valetax. And I always say that in order for you to be, you first need to become. It's a very popular quote for me as a person. In order for you to be, you need to become. So let's take, for instance, you can't be a doctor if you do not become a doctor. You can't be a lawyer if you do not become a lawyer. You can't be a politician if you do not become a politician. You can't be anything if you do not become that thing. So in order for you to be a trader, you need to become a trader. And being a trader isn't just technical analysis. It's a full breakdown and through of who you are as a person. It's going to test all your emotions because at the end of the day, it's something that has to do with what? It has to do with currency. And when currency is the topic of discussion, then you know that the human mind can be very fragile when it comes to things like that. So it's going to test everything you have, your fear, your greed, your stress, your emotional fatigue, your consistency, your discipline, your persistency. All of these things are going to come in check. So you need to be ready to become a new person as a whole to stay in the financial market long enough. So things that would affect, your trades and why your setups will fail. It's not really that it's bad. Sometimes you could have a good setup, but then fear comes in because now you might have, over leverage, you might have doubled down on your risk and now you're scared. Greed can come in. You could be on a perfectly good trade, okay? And instead of you to just take profits, you're waiting for higher. You don't have a specific target. You use a big lot size and then you get greedy, and then you could get stressed. When you get stressed, probably from taking a couple of losses, or you've had a terrible day, or it could be emotional stress, it could be, crisis at home, your personal life crisis and all of those things, and you decide to take a trade, you would not be trading from a place of clarity. You'd be trading from a place of what? From that emotion or from lack. And these things would also affect your trading. Emotional fatigue, it could just be that you've had losing streaks, and instead of you to give up, now you're emotionally fatigued and then you want to start revenge trading. And that is where the problem usually would come from the moment you start revenge trading. So those are some of the things that actually make your setups fail. And in order for you to do that, you have to learn them, understand yourself, and build a discipline around them. Learn to call out your emotions at this very point in time. Okay. So sometimes I could be on a trade and I'm starting to feel a certain way, and I could just tell myself I'm panicking because I doubled down on my risk. And then I could just choose and say, you know what, I'm going to close this position. And don't get me wrong, okay? There are times where you would falter. There are times where I'm like, I still believe in this trade, even though I know I've done the wrong thing. And then I hold it and I end up losing the trade. So there are times like that. But I've said this before and I'll say it again. There's no perfection in emotional control. It's management. You can't control your emotions fully. You manage them. So what you want to do is always be in a position to catch yourself before it happens. Be aware. So first step is to be aware of these things. So have a journal, create a journal, be aware of it. Always write before you take a trade. Write the trade you're taking if possible. If you're someone that you have a journaling app, you use that. If you're a mental person like me, I'm very, very, very much mental. So I could take a trade and keep it mentally and record it. I can tell you the first trade I took at January, the first trade I took in February. I could tell you my last trade from last week and all of those things like that. So I have a mental system of journaling my trades. But you see, my emotions, I always write my emotions down, because one of the best ways to get over something is to write it down. Once you can write it down, it means you've identified the problem. So now your brain is aware of that problem. And once that awareness is available, then you can start to fix and solve the problem. Okay. So awareness. So learn to journal how you're feeling when you take a trade. That would also help you. Okay. And study it. Okay. So um so let's talk trading psychology. So let's talk trading psychology. Okay. So your biggest edge is not just technicals, it's emotional discipline. And why that is so is, like I said, if you're not in an emotional state, no matter the system, in a good emotional state, no matter the system you put in place, you're going to end up losing, because your emotion dictates how you react to things. So a little shiver in the market could just make you close the trade and you end up missing a good trade. A trade could just be floating in a little drawdown before it goes back into profit, but your emotional state is not good enough. You end up closing the trade and then you go out of the trade. You could be in a losing trade, and instead of you to close the trade, you're being highly hopeful and optimistic about the trade, and then it goes against you and then you lose money on the trade when you knew you should have done the right thing. But at that point in time, your emotions are too much. So you're not thinking properly. So once you can create the discipline within your emotions, then you can have a stable ground to then say, okay, on to the next, on to the next, on to the next. And mind you, losses are inevitable in the market. But with a strong emotional discipline, you can tell yourself, oh, bad day, we took a loss today, on to the next, we come back tomorrow. But if you do not have a good emotional discipline, you're going to feel like the market is against you, and then you want to win. And the mind of humans is, we don't know how to accept losses easily. So when you when you take a loss, you take a loss, you take a loss, and you can't be disciplined enough to tell yourself, oh, hold up, it's enough. It's not the market, it's me. Probably I'm just reacting too much. And then you go back to want to try and trade again. Then you start revenge trading. Then you start over trading. Now you're losing clarity. You're completely out of clarity. But once you have that emotional discipline, you can tell yourself, okay, this has happened and it's okay. I would move to the next. And then you come back tomorrow refreshed with a fresh mind, and you look at the chart again, and then you can place your trade using the same system and strategy. Because you can have the best system in the world, but without the right psychology and emotional discipline, you're always going to lose. And that's the truth about it. And trust me, coming from me, with my experience, I'm a living proof. I can tell you, I was on a trade on GBP JPY for over 2 weeks, but it just started ranging too much. I know it's going to buy. I have the belief. I won't say I know it's going to buy, but from the market and from my analysis, it's showing me that it's going to buy. Fundamentals are also showing me that it's going to buy. But the range is just too much. And at that very point in time, when I closed out the trade, I wasn't having it emotionally. I was going through too many emotions at that very point in time. So it started to piss me off. I could literally see my emotions on the chart because the range was too much, and it started to feel like how my emotions were. And I just exited the trade and I made peace with it. So things like that are, how your emotions play a role when it comes to your trading as a trader. Okay. So what is the fix? Okay, so I believe that we've understood everything that I have said. I don't know if I should go through it again, but for my pre-session review, we've spoken about why traders fail. We've spoken about how to avoid it, or how to, avoid why traders fail. We've spoken about the need for, proper technical analysis. We've spoken about how to use fundamentals for your technical analysis, not just using plain candlesticks and charts. We've also spoken about gems. We spoke about order block, liquidity zones, and we spoke about confluences. And we also spoke about how to manage your how emotions are very important and how psychology plays a big role in your trading. But now, how do you align your mindset with your analysis? It's all about psychology. Your system, okay, your psychology should be part of your system. It should be part of your plan. It should be something that you consistently pay attention to and work around it. And the first thing you need to do is journal your trades. So take a trading journal. You can create one for yourself. What you want to do is write the time, the date, the price, your stop loss, your take profits, your entry, and then you then want to write your emotions at that point in time. How did how did you feel when you were taking that trade at that point in time? You want to put down all of all of these things together, okay? And then use that as a way to analyze you as a person, not just your trade at this point in time. Okay. So once you do that, you can then study how you felt when certain things happened. So you can easily journal, oh, I was on a trade on USD JPY buys, but prices started to reverse. And why prices started to reverse, I started to feel a certain way. I started to doubt my analysis at this very point in time. Do I know why I was doubting my analysis? Then you go back and you sit back and you think about it. Why was I doubting my analysis? And then you go back to your journal again and say, oh, I doubted my analysis because I saw in a Telegram group that someone called sells on USD JPY, and I could also see that it seemed like they were in profit. So I started to doubt my analysis. Nevertheless, my system showed that this was buys for me. Okay, now you keep that. You come back probably 30 minutes later or an hour later when the trade, is still going your way or something of that nature. Then you can then tell yourself, oh, I closed out this trade because this and this and this and this happened. But the trade eventually went my way and my direction. Lessons learned from this is next time to pay close attention to my own analysis and trust in my analysis. Simple. So now you've been able to identify why you felt that way while you were journaling your trade. So tomorrow, when similar thing happens, you don't just jump out of the trade, but you sit back to then process and call out the emotion you're feeling now, and then stand from it, and you take decisions from a standpoint of clarity, not just excess emotions any longer. I hope that makes sense. Okay. Now another thing you want to have is like a daily checklist for your entries. So don't just trade too many pairs at the same time. You could analyze 5, 6 pairs. That's fine. But then within those 5, 6 pairs, pick the ones that gives you the most technical edge in line with your system, and pay attention to those ones, and then create a daily checklist. So probably you can say, okay, I see sales on gold tomorrow after prices breaks, when price breaks this price level, I see buys on USD JPY, I see this. And then you can have maybe just 2, 3 of them and have an entry checklist for them. So when you make that trade on that entry checklist, you click it. You make that trade, you click it. You make that trade, you click it. Now that gives you confidence in yourself as a trader, knowing that you paid attention to what you were supposed to do. That builds discipline for you. That helps you come back to the chart every day and do the same thing every day. And that builds a better psychological edge for you. And these are my 2 major tips for you to align your mindset with your analysis. So once you can journal, you understand how you're feeling. The next thing is to understand why you're taking the trade, to have an entry checklist and do your proper analysis using your system or your edge. Okay. Okay. So my summary, I believe, like I said, price follows liquidity, not predictions. It always wants to know where the most money is in the market to take them. Order block and psychology would give you good consistency. So you can use order blocks, you could use key levels, and then make sure that when you're using this thing, you want to use it with confluence. And your psychology, like I said, is part of your trading system. You can't take it away from it. So you need to make sure that psychologically you're good. Then you pay attention to your technical analysis. Okay. So this order blocks here is your technical analysis. Pay attention to your technical analysis and your psychology, and that would equals to consistency. Okay. And here at Valetax, we give you tools to help you build more confluences. You can make use of our analysis IQ. We have an analysis IQ as a member. So all you have to go to our tools section on your dashboard. Okay, you see the tools section. Go to the analysis IQ. You would see the calendar, you see our analysis, you see our expert reports and all of those things. You can learn from them. Yeah, someone was asking earlier on where you could learn about news. You can learn about news from the Valetax website if you use our analysis IQ and news impact page as well. You could see all of those things there. You could learn from them. Okay. Um, so I would show us that. Okay, I'll show us that very soon. Okay, so I want to say thank you, but before then, let me quickly show us how to use the the Valetax website, okay, to study your fundamentals. Okay, so you want to go to your member area. Okay, so you want to go to your member area. So I'm just going to log in now. Okay, going to log in, go to your member area. Okay, so when you go to your member area, you can see you have promotions, copy trading, contests. Okay, so what you want to do is come to analysis. When you come to analysis, you see our analysis IQ here. So this gives you um gives you insights into the markets where we are seeing strengths and weaknesses in certain currency pairs. Okay, so you can see, so you see the confidence level and all of those things there, where we have our possible entries, targets, and um and when it expires. So we give you time. So you don't just come into the market and use it anyhow. So you can see the time. So you know how long, you should be expecting to take the trade. And the entries are usually limits, not instant executions. Okay. Then you have the so this is where you notice the strength. So someone was asking for strength, when to know if it's bullish or bearish. So you have like a strength indicator here. Okay. And then you can use this and go back to your chart. Okay. And then use it as what? As a possible confluence with your chart, not just using it alone. Remember, this is not this is not a signal. Okay. This is a strength indicator. Okay. There's no guarantee to success of it. Okay. But it is a research that has been done by expert traders to help you build confluences around your own trading as well. So we also have our research terminal. Okay. You can, if you've studied, you can come around, study this, play with it, and understand how it works. Okay. You see we have the news volume, the fear index, why people are scared of it, and all of those kind of things. You can use this for stocks, for currencies, and and even commodities like coffee, gold, and all of them. Okay, so you can use this, so you can see what price is, and you can see what people's sentiment are. Some people want to buy, some people want to sell, but it's price and big banks really looking to buy or sell at this very point. Then most importantly, again, the economic calendar. So we give you all the possible news for every day and every week. So we're going from high impact to low impact. You have access to all the news. You see, this was the last Fed rates interest decision, and it was left at 4.5%, no change. Unemployment rate for Russia is still at 2.2%. Okay. The FOMC press statement is about to end as well. And you can just come here, click on it, and read on what is happening presently. Okay, so you can see what does this FOMC conference affect. You can see it tells you all about it. It shows you the sentiment, and then you can even go further to view all the assets that it affects, and you can even go further to read more. So this is how you can take advantage of the Valetax analysis um, um, section. You can also join our Telegram channel and also be a part of future analysis, shared analysis, and setups. Remember, like I said, it is not a signal and does not give you assurance to success, but it is just price speculation and market idea to help you build more confluence around your own. Okay. So for those of you who might be interested in the contest, this is the contest and it's still going on. You just need a minimum balance of $30 to get started on the contest. See, duration is 26 days. It's expiring on the 4th. It's expiring on the 8th. Sorry, it's expiring on the 8th of this month. Okay. And winning seats is 10. Winner goes home with $1,500 for first position, and others go home with 500, 300, and $200. Okay. So you can join in. All you need to do is come to the activation code and type trade first in capital letter like this, just in case it's not showing on your own side. And once you click on it, it would appear like this. Okay. So that is how to go about your Valetax member area. So you have different account types. Okay, you can choose, you can have your broker wallet, you can have different accounts, you can have your big accounts, your small accounts, anyone at all that you want to use and trade. So thank you guys so much for joining the webinar, and I'm going to be going through the questions right now, and if you have more questions, please do feel free to drop them in the comment section. So far, so good. If you've enjoyed the webinar so far, please just leave something in the comment section. Okay, someone is saying, please show me your MA settings. So, Afeso, my moving average settings is I'm using the EMA, the exponential moving average of the period of 21 or 24. Works perfectly fine. Okay, Incredible Sam say, how do we validate order block? I mean, in cases where we have multiple order blocks in a specific area, is there a specific way to know which one will hold? The specific way to know which of the order block will hold is to find the order block nearest to the liquidity. The order block nearest to the liquidity is the one that would hold, because at the end of the day, the liquidity should be constantly trying to approach that order block and fail to approach it, but instead keeps coming back and dancing around it. That's the order block to use. And also another way to validate is the order block, the one that is responsible just before the break of that structure is also very important for you to pay attention to that one. Aha, so someone answered you already. Afeso answered you. Afeso, that's very good. Thank you so much. And that's very knowledgeable of you. The one closest to your liquidity or inducement is the right order block. Someone said, I'm in a serious drawdown. How can I overcome it? Honestly, if you are in a serious drawdown, the one way you can overcome is cut your losses short. Don't stay too long in a losing trade. It's one way that I personally have lost a lot of money and destroyed my P&L, holding a loss too long. There are times where you're in a loss and you know your mind is telling you this trade is not going to come back. You've seen the invalidation of structure. Stop holding it. So stop holding that trade. Okay. Uh Someone said start saving money for an account. And also in picking order blocks, are we supposed to focus on the body of the candle or with the wicks, especially for candles with longer wicks? Focus on the whole candle. See, the wicks you see could be a candle on another time frame. So usually I like to analyze my order block using different time frames. So if I find an order block on the 4 hourly time frame, I might want to refine it. I might go to the daily to see if I can still see the order block, then refine it from my 4 hours back to my 30 minutes. Then if I see that on my 30 minutes, I can refine the order block very well to find where the actual block is, fine and good. But usually I would advise that you just use a 50% of that candle. So use the whole week and then use the 50% of it for your entry position. Okay. I prefer it with weeks because if you neglect it, you'll just be missing the trade. And be mindful, choose the one that works for you most. Yeah, that's true. There's a need for that. If the candle wick is longer than the body, use only the body. If it's a small candle, use the body and the wick. Do you use breaker blocks, sir? No, I do not use breaker blocks. No, I do not use breaker blocks. So I believe that I have been able to answer all the possible questions that are here. And if you've been on this call so far and you enjoyed the session, I just want you to leave thank you, Valetax, in the comment section. Guys, thank you, Valetax. Thank you, Valetax. Let's just leave that in the comment section. Just put it down. Thank you, Valetax, in the comment section. Thank you, Rion, in the comment section. Let me be sure that we've all been following so far, and it was an amazing session. If it was an amazing session for you, just put thank you, Valetax, and thank you, Rion, in the comment section. Afeso, my moving average settings, I will just type them out for you. It's an EMA 21 period or 24 period used on 4 hour and 1 hour to determine inter-day trend. 15 minutes use for entry. For order block confirmation, it depends on the kind of trader you are. Depends on the kind of trader you are. If you are a long-term trader, you want to use 1 hour order blocks. They work best because you're sticking with the 1 hour structure. If you're on the 15 minutes, basically there's no really time frame to confirm a good order block. You want to use the order block according to the structure on the time frame you're in. So let's say if you're on the 15 minutes time frame and the market is bullish on the 15 minutes time frame, then you want to pay attention to the order blocks on the 15 minutes time frame structure, because at the end of the day, price is fractal. So what happens on the 4 hourly, on the 1 hour time frame, is always most likely going to happen also on the 15 minutes, on the 30 minutes, on the 5 minutes time frame. Okay, so that's the fractal nature of prices. Okay, thank you guys so much. I see the messages. Thank you, Rion. Thank you, Valetax. Thank you, Valetax. Thank you guys so much. And thank you guys so much for joining the webinar today. And if you did enjoy the webinar, do not forget to get registered with Valetax Broker Global and get signed up, fund your account, and I promise you, you're never going to regret trading with Valetax. Like, our spreads are amazing. I mean, I've shown spreads on my community, on my social media. We've also shown that on our social media page, and also follow our social media page at valetax.official on Instagram, Valetax official on TikTok, Valetax Africa on Instagram as well. And you would see my face, and you'd see beautiful contents about trading, tips, education, understanding fundamentals for that also on our Instagram and TikTok page. So do well to follow, and we would see you guys on the next webinar again. And thank you guys so much for joining. And as always, it is Rion for a reason, baby.